Ladies and gentlemen, good day and welcome to Nuvoco Vistas Corporation's Limited Q1FY22 Investor and Analyst Conference Call. At this moment, all participants are in the listen-only mode. Later, we will conduct a question and answer session. At that time, you may click on the Audio Questions tab below the media player or submit your text questions. Please note that this conference is being recorded. I now hand over the conference to Mr. Gavin Disa from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and thank you for joining us on Nuvoco Vistas Corporation Limited's Q1 FY22 conference call. We have with us today the Managing Director, Mr. Jayakumar Krishnaswamy, the CFO, Mr. Manish Agarwal, and the Chief of Strategy and Marketing, Madhumita Basu, who will represent the company on this call. Before we begin, I would like to point out that some statements made or discussed on the conference call today may be forward-looking in nature and must be viewed in conjunction with the risks that the company faces. The company does not undertake to update them. A statement in this regard is available for reference in the presentation shared with you earlier. We will begin the call with opening remarks from Mr. Jayakumar Krishnaswamy, who will share perspective on the business model and strategy of the company. We will then, post management sharing their views, open the floor for an interactive Q&A session. I would now like to invite Mr. Jayakumar Krishnaswamy to share his views. Over to you, sir.
Thank you very much, Gavin. And welcome to all of you for the Nuvoco Vistas first investor presentation post our listing. In the last 2 to 3 months, we must have met many of you in person or through calls or through video conferences. And this is the first time we are having all of you on a post-results conversation, and I would have a formal presentation about the company, following which we'll have a Q&A session. Along with me, we have Madhumita Basu, who is our Chief Strategy and Marketing Officer. Henceforth, she will lead the investor relations functions for the company, so she would be our contact point going forward. I also have Manish Agarwal, our CFO, who's besides me here. And with the three of us, we will take you through the company's details as well as the results for Q1. The format for today is going to be a company review all the way to key projects update. In between, we'll talk about the business strategy, key financials, our ESG agenda, as well as an update about the IPO. I would now ask Zed to play the audio visual for the company. Over to you, Zed.
Sir, you may go ahead.
Thank you, Zed, for playing the video. Ladies and gentlemen, the video which you just now saw gives a glimpse of the company, its operations, products, portfolio, and rest of all the stuff. The coming few minutes, I'm going to talk to you about the company in a little bit more detail. Let me start sharing the company's vision with all of you. The vision for our company is to build a safe, smarter, and sustainable world. Safety is an important agenda for the company where we ensure personal safety, equipment safety, and product safety. When it comes to smarter vision for the company, we are committed to developing and producing products and solutions to the consumers which are smart and innovative. And last but not the least, sustainability is a core mantra for the company in everything which we do in terms of running our operations, producing products, and our commitment to the nature and energy. The mission for the company is to become a leading building materials company delivering superior performance. When we say building materials company, we're talking about the cement division, the ready mix division, and the modern building materials division. So our mission is to become a leading building materials company in terms of performance. These two vision and mission are having a foundation which is the values for the company. The values for us is integrity, entrepreneurship, collaboration, care, and operational excellence. With these values, vision, and mission, these are the guiding force for the company as we build Nuvoco Vistas Corporation going forward. Let me talk to you about the company. We are a major building materials player, #1 cement company in East India, and the 5th largest in India in terms of installed capacity. Our installed capacity as of June end was 23.82 million tons. The 4 important facets which I want to share with you, we are the fastest growing cement company in the country, details of which I'll talk about later. We have strategically located production facilities in East and North India, and we have market leading brands. Again, I'll talk about it a little later. And our company really focuses on retail. Our trade to non-trade ratio is to the tune of currently 80 to 20%. In terms of the growth of the company, we started with the plant in Nimbol in 2014 with an installed capacity of 2.28 million tons and have progressed in the last 7 years to 23.82 million tons, a 10x growth in a short span of 7 years. No other company, cement company in India has achieved such kind of growth in such a short span of time. In terms of the locations of the plants, we got 11 manufacturing facilities for the cement division. Most of it is located in East and North India, and we got grinding units in every state of East India. In terms of the ready mix business, we're located in all the 4 regions, overall 49 plants, and the 50th plant of the country is coming up in Numaligarh in Assam as we speak. Coming to the product portfolio, we have the flagship brands Concreto, Duraguard, and Double Bull straddling the price points right from super premium all the way to the economy. Double Bull is the fastest growing brand in the country, 0 to 5 million in a short span of 5 years. Concreto is the highest priced brand in the markets where we operate. Duraguard offers a huge range of premium products. In the ready mix side of the business, our brand portfolio include Concreto range, Instamix, Artiste, and Xcon. And in the modern building materials, our brands are 0M and Instamix. Over 50 different products we manufacture in these 3 business verticals. All this is backed up by a very strong R&D. We call it the CDIC, Construction Development and Innovation Center, based in Mumbai, where we churn out new products that meet consumer expectations. Coming to the track record of our company, the Nirma, our parent company, entered the cement space through setting up our plant in 2014 in a place called Nimbol in Pali district of Rajasthan, and then on grown strength to strength. In 2016, we acquired the erstwhile Lafarge and rechristened ourselves as Nuvoco Vistas Corporation. We had the portfolio of brands which I spoke about, Concreto and Duraguard, backed up by a very strong relationship trade channel. The company focused on productivity improvement in the initial years, and in 2018, we took a major decision to install captive power plants and waste heat recovery systems in all our plants. We now have all the integrated plants with WHR and CPP. We invested close to 100 megawatt and 100 megawatt of CPP and 25 megawatt of WHR in the last 2.5 years. And overall, once the Jojobera and Arasmeta CPP are commissioned, which is going to happen in the next 1 to 2 weeks, we will have an installed CPP capacity of 150 megawatt and WHR of 44 megawatts, totaling to about 195. And when commissioned, 70% of our power requirements will be met by these in-house power systems. And in 2020, we acquired the Imami cement business, rechristened as New Vista. New Vista is a wholly owned subsidiary of NVCL. And in the balanced presentation, when we use the word Nuvoco, it will construe both NVCL and NVL. And as I spoke a little while earlier, Double Bull is the fastest growing brand in East India, and we have best-in-class manufacturing facilities in the New Vista facilities and among the lowest cost producers in the country. And with a combination of New Vista and Nuvoco, we are looking at huge synergy between the two companies and with an opportunity to unlock value and potential. I'll now talk about the IPO which went past us in the last 1 month. The company raised 5,000 crores through the IPO, 3,500 crores through the OFS route, and 1,500 crores through the primary. The stock got listed on the 23rd of August on BSE, and the issue was subscribed by over 1.7 times. We have a strong participation from marquee investors across the globe and India, comprising of mutual funds, leading insurance companies, and other financial institutions. The proceeds of the IPO will be used to pay the debt in the coming quarter. As I spoke before, our mission is to become a leading building materials company delivering superior performance. With this, I will now invite my colleague Meeta to talk to us about the business strategy of the company. Over to you, Meeta.
Thank you, Jay. Good afternoon, ladies and gentlemen. I will be sharing with you the business strategy and the ESG agenda of the company. The first and foremost pillar of our business strategy is the revenue pillar. As the fifth largest cement company in the country, we are committed to consolidating and growing our market share. We will be leveraging our leadership in East and North, primarily with focus on trade-centric business and premium products. To enable this growth, we have already undertaken a program for clinker debottlenecking in 3 of our IUs. This will add 0.9 million tons per annum of clinker. This additional clinker with an enhanced C/K ratio will support a 2.7 million ton cement capacity expansion. Of this, 1.5 million tons has already been commissioned in our Jojobera plant in Jharkhand. Post this, in our next phase of growth, we will be looking at Central and Western India, given that we already have a presence in some of the significant Central India markets, as well as our limestone reserves in North Karnataka. The company has 2 other business verticals, ready mix and modern building materials, with a slew of products from construction chemicals to dry mortar, dry concrete, as well as wet concrete and 35 kg consumer packs. We see these products as the future of construction and will be committed to driving opportunities for growth in these business verticals. Our revenue will be largely focused on trade-centric and brand-centric building of the business. We have a very strong network of dealers and sub-dealers with a robust CRM program. Our 3 brand verticals, Concreto, Duraguard, and Double Bull, allow us flexibility in a multi-price point strategy. Concreto as the best price cement in its footprint markets, Duraguard, which is a premium product with value-added variants like a microfiber reinforced cement, and Double Bull, which has been the fastest growing brand in recent times. Driving revenue will be a significant contributor to our EBITDA. The second important pillar is the profitability pillar. Here in operational efficiencies, Jay just shared with you our plans for waste heat recovery and CPP systems. Collectively, this will contribute 70% of our power requirement and will be a significant lever in driving power cost. Pricing acceleration program has 3 parts to it: focus on premiumization, growing our trade operations, and better geo mix optimization. We have a robust portfolio of premium products. Concreto will continue to be our focus brand, driving the best prices and volumes in its footprint markets. We will continue to innovate. Value-added products will be our route to driving premiums and sustaining the premiumization program. With the acquisition of New Vista, we have in place an accelerated program for driving synergies. We will focus on enhancing scale of operations to maximize incentive benefits. We will drive synergy in areas of logistics, cross-sourcing of our brands and products from all our plants, and procurement synergies. The larger scale of operations will enable us to drive benefits in operational efficiencies. With this, I move to the two levers of process and culture, which enables us to drive strategy through the organization. We have in place a robust SAP platform IT system. We run an integrated SNOP across the organizations. These processes has helped us to accelerate the assimilation of the New Vista business. On the ESG piece, I will be shortly sharing a more detailed version in a couple of slides. I will move on now to the most important element, our people. We have very strong O&HR and L&D processes, which helps us to attract, develop, and retain the best talent in the industry. With the acquisition, we have also been able to provide strong career opportunities for growth to the right skill and talented people. I will now take you through our ESG agenda. Sustainability continues to remain a key thrust area, and here I will share with you the various programs on which we are working. On waste heat recovery, we have already shared our focus. All our IUs have waste heat recovery systems, and at a power to clinker, we are one of the best in the industry. The company is committed to a 10% water reduction program year on year, which includes rainwater harvesting and reuse of water across our cement and concrete plants. Our company also offers a very unique product, Concreto Green, which consumes 25% less water in concrete mix preparation. On the waste management front, all our factories and colonies have STPs, and the treated water is used for green belt development. On the environment front, the company is committed to use of alternate fuel. At 16% alternate fuel at our Chittorgarh plant, we are one of the industry benchmark. There are plans to equip our other two plants, Nimbol and Rishta, for alternate fuel capability. We have solar power facility in our Bhiwani and Chittorgarh plants and are considering a couple of our GUs for further installation. On the green footprint, we are committed to tree plantation and also for use of alternate sand and aggregate materials in preparation of concrete. This is under our Concreto EcoDure program. On CO2 reduction, the company has one of the best blended cement ratio. Our C/K ratio at 1.7 is significantly better than the industry average at 1.4. Further, we are committed to improving the C/K through an accelerated plan for introduction of composite cement. I will now share with you our 5S program for CSR. Education under the program Shikshit Bharat is focused on equipping government schools with modern education facilities. Under the health program Swasth Bharat, we focus on the adolescent girl child. Under Surakshit Bharat, we take forward our safety culture and knowledge to the related rural communities, developing Gramin safety ambassadors in our communities. Saksham Bharat is the livelihood-focused program. Here we do skill development of women, enabling them to be self-reliant. Sanrachit program is our program for developing infrastructure, and we are committed to provision of safe drinking water. The company has one of the strongest governance processes. Our board is diverse mix of executive and non-executive directors and an independent women director. We have strong audit processes. Our internal audit is conducted by an external audit firm. The audit report is shared with the audit committee, and we have quarterly meetings with statutory auditors. All related party transactions are entered into at arm's length and further reviewed by the audit committee. With this overview, I will request our CFO Manish to walk you through the key financials. Thank you.
Thank you, Meeta. Good afternoon, ladies and gentlemen. In the next few slides, I'm going to walk you through the key financials. So firstly, on the key highlights for Q1 of this financial year. So during the roadshow of our IPO, we had the following key areas which were planned, and I'm going to give you an update on the same. So firstly, we have been able to recover the volumes post the COVID in the Q1. The price acceleration program is already up and running in the company, and it's giving very positive results, both in terms of increasing our realizations as well as revenue. So this has three components to that price acceleration program. First is increasing the basket of our premium products, increasing the trade share, and also optimizing on the geo mix. The synergies between New Vista and NVCL have already commenced across all themes, which are reduction in the logistics cost, reduction in the clinker transportation cost, procurement synergies, and also adopting the best practices between both the companies. Now, with the increase in the overall power generation because of the captive power from the CPPs and WHRS, we have been able to drive more benefit on the power cost savings, and this has led to a reduction in our power and fuel cost, despite the fact that there has been an increase in the pet coke and the coal prices. We have started getting the benefit of the scale, and this is clearly visible because of the volumes that we have been able to get in Q1. Our fixed cost and SGA per ton has reduced. We have been also able to turn around the NVL business within 6 months of acquisition, and this has helped us to improve our PAT. Now, in the next few slides, I'm going to be talking about the Q1FY21 numbers, wherein we have also included New Vista numbers for a like-to-like comparison, as the New Vista acquisition was done in July 2020. On the key indicators side, at the consolidated level, so first of all, on the volume side, we have got an increase of 44%, and the overall volumes for the first quarter is 4.2 million tons. On the revenue side, there is a 59% increase on a YOY basis at 2,203 crores. The total EBITDA for both the companies put together is at 520 crores, which is 126% up on a YOY basis. Our EBITDA margin has increased by 7 percentage points to 24%, and our EBITDA per ton has increased to 1,238 rupees, which is 58% YOY. The increase in the EBITDA is coming from the four levers. First of all, the increase in the volumes, the synergy benefits between New Vista and NVCL, the benefits or the savings coming from the CPPs and WHRS, and lastly, the reduction in the fixed cost and SGA on a per ton basis. On the income statement side, so there has been a marked improvement in operational performance coupled with the increase in the overall volumes and the synergy benefits between New Vista and NVCL. This has helped us to get an overall EBITDA of 520 crores in the Q1, which is 126% up from the same period last year. Our EBITDA margin has also gone to 24%, which is again 7% up. With this sort of strong profit performance, our overall PAT for the first quarter is at 114 crores. To talk about the key elements on the cost side for the cement business, so raw material cost is at 555 rupees. This is at par with the last year same time. Despite the fact that there has been an increase in the input cost, primarily on the slag side, because of the raw mix optimization that we have done, we have been able to neutralize that cost increase. On the power and fuel cost side, we have got a 3% reduction, and now the cost is at 917 rupees per ton, despite the fact that there has been an increase in the pet coke and coal cost, but the overall generation of captive power has increased from our integrated plants, and that's the reason why we have got that sort of a saving. In terms of a distribution cost, so this includes both the logistics cost that is incurred for servicing the markets, plus also the semi-finished goods transportation cost, which is basically the clinker cost that is incurred from the integrated plants to the grinding units. So in that, there has been a lot of synergy savings which have started flowing into our financials because of the synergies between both New Vista and NVCL. We have started getting the benefit of that. Our lead distance has reduced by 45 kilometers in NVCL, and that's the reason why we have started getting this sort of a benefit. However, at the same time, there has been diesel price increase in this quarter as compared to the last year. On the deleveraging side, there has been a 0.5x reduction in the quarter one because of the operational performance. Now it stands at 3.7x. The IPO proceeds are being used to repay and prepaying the debt. This is going to help us improve our capital structure and also will give us the flexibility to fund our next level of growth. With this sort of strong operating performance, CRISIL has also revised its rating on the long-term debt, both for bank facilities as well as the debt instruments, to AA with a stable outlook. With this, I would request Jay to just update us on the project side, please.
Thank you very much. In this section, I'm going to talk to you about the key projects of the company and where do we stand in terms of the various projects. The first chart talks about the three main projects the company is embarked on. One is to set up the captive power plants in all the integrated units and the Jojobra grinding unit. Happy to report that other than the Arasmeta plant as well as the Jojobra plant, every other CPP and WHR is commissioned and working. And in this week, we are going to fire the boilers for both Arasmeta and Jojobra. And from October 1st this year, these two plants will start generating power, which is part of that 150 megawatt of captive power plant and 45 megawatt of waste heat recovery systems. The second important project we are embarking is the clinker debottlenecking in 3 of our kilns, out of which 2 kilns we have already started the work. The one in the Nimbol plant in north and the Risda plant in the east, work has already commenced and we are expecting to commission the debottlenecking by FY23. This should increase the overall clinker capacity of the company. The third major expansion is almost complete, rather completed, and plant is commissioning. The final touch-up is happening. However, the plant is under production mode now. The 1.5 million ton grinding unit expansion in Jojobra is commissioned now. The plant is delivering numbers. The final site development is happening as we speak. Overall, in this quarter, we spent 113 crores. But in this fiscal FY22 and FY23, we're looking at a capex of over close to 1,000 crores, which will be involved in debottlenecking the plants and brownfield expansion, and that will increase the capacity of the company further than 23.8. The other aspect was the update on the synergy and the potential unlock between the two companies, New Vista and Nuvoco. One of the major agenda when we combined the both companies was to launch Double Bull in the north. And happy to report that the Double Bull brand has already been launched in North India, other than Rajasthan, in all the states of Haryana, Western UP, Punjab, Delhi, and MP. This is all launched right now, and that will be in the trade channel in a separate network. The other synergy projects are all well on their way. The first one is cross-sourcing between the two companies, making of Nuvoco products in New Vista factories and New Vista products in the Nuvoco factories, rerouting of clinker from Risda via Sonadih to the various grinding units, getting the procurement synergies between the two companies. We have combined the procurement function. And last but not the least, both the companies had various manufacturing practices which were very cutting edge. And now with the combination of both the companies, we're able to cross-pollinate the best practices between the two companies. All this will unlock value to the company, targeted to unlock value for the company, the tune of 250 rupees per ton in a period of 24 months, out of which we are targeting about 150 rupees in this fiscal, another 100 in the next fiscal. The third important thing for the company is the various innovations we have embarked on and launched new products in the marketplace. The Duraguard Silver is the premium variety of composite cement that is now launched in Bihar, Bengal, and other parts of eastern India. And the other plan is to roll out this same product in the rest of the geographies. On the ready mix side, we launched 2 new products, Concreto Permadur and Concreto Corrosive. Both these products are cutting-edge products, one to inhibit corrosion, and the second one to inhibit cracks. All these products were launched during the quarter. As a testimony to our efforts towards innovation, we also secured an external accreditation during this quarter. With this, I just want to sum up what we have been speaking in the last 25 minutes. We belong to a strong infrastructure sector where in the next few years, India is going to really grow and cement industry is going to be a flagship sector going forward. And Nuvoco being a market leader in East India and sizable position in North India, we are nicely poised to get this growth in the industry. We have market leading brands, Concreto, Duraguard, and Double Bull, straddling the various price points, largely focused on trade and having a better realization because of position in the trade market. Plants located in key markets of East and North India, grinding units in every single state in East India, and ready-mix plants across the country, gives us a very sizable advantage in terms of participating in all the markets. And the most important thing is with the combination of New Vista and Nuvoco, we are slated to unlock potential from both the companies in terms of revenue, in terms of profitability, in terms of capacity, and that we will see in the coming 2 years. And lastly, the company has got strong processes like IBP and very good information management systems, strong people-centric processes, and last but not the least, huge commitment from the management for the ESG agenda for the company, and that will take us one of the leading companies and our mission to become a leading building materials company delivering superior performance. That in short is the presentation from the management, ladies and gentlemen. We'll now take off the charts and open the meeting for Q&A. I will now hand over the control to Gavin and he will conduct the Q&A session. Over to you, Gavin.
Thank you very much. We will now begin the question and answer session. To ask an audio question, please click on the audio question tab below the media player. Click on OK on the pop-up to mute your webcast to proceed with the Q&A session. The operator will announce your name when it is your turn to ask a question. Please unmute your microphone while proceeding with your question. To ask a text question, please type your question and submit. Your question shall be addressed by the panel members. We will wait for a moment while the question queue assembles. Mr. Disa, in the meanwhile, the queue assembles for audio participants. Would you like to take up questions which have been submitted on chat?
Yes, I'll start with a question on chat, which is from Manish Oswal of Nirmal Bank. He says, first of all, congratulations to the team at Nuvoco for such a strong core operating performance in 1Q FY22. He's asked about what is the capex outlook for FY22 and 23, which has been touched upon in the presentation. But the capex outlook, and with waste heat recovery plants and premium products, where do you see sustainable EBITDA per ton? And what is the scope for improvement in EBITDA per ton over the next few years? I'll go forward and up to you.
Okay, so you asked 3 questions now. The first one was, what is the capex plan for the company? As I mentioned during the call, our capex plan for the company for the next 2 years is in terms of debottlenecking 1,000 crores. And over a period of next 5 years, we're looking at 1,750 crores, out of which 1,000 crores will be for debottlenecking projects and 750 crores will be for routine capex in the factory. Out of this 1,000 crores, this year we are targeting to spend 505 crores, broadly spent on the debottlenecking of clinker projects in Nimbol as well as Risda, and also various other routine capexes in the factories. The second question which you asked was, what is the impact of captive power plants in WHR? As I spoke during the presentation, the major initiative was undertaken 2 years ago to set up captive power plants and waste heat recovery systems in all our plants. 2 of the projects are in the final stages of completion. By Q3 of this year, we would have completed all our projects, and with that, we'll have 150 megawatt of captive power plants and 45 megawatts of waste heat recovery systems. These projects is slated to give us savings of close to 220 crores to the bottom line, out of which in fiscal FY21 till fiscal FY21, our company has accrued about 100 crores in terms of EBITDA improvement. The balance 120 crores will happen from Q3, is already happening, but since the 2 plants are going to be commissioned in Q3, in the next 12 months, the anniversarying of the full savings will happen, which would mean at 120 crores incremental EBITDA improvement with the volume which you are targeting this year and early next year. We're looking at close to about 50 to 55 rupees per ton improvement in EBITDA coming out of captive power plants and WHR savings. Gavin, what is the next part of the question?
Yes. So what are the debt reduction plans for FY22 and 23? And what are the current capacity utilizations across all our plants?
Okay. In terms of the debt reduction plans, as we reported during the IPO time, the debt in the books of the company around the IPO time was 6,886 crores, and the IPO proceeds of about from the primaries about 1,500 crores which we raised in the Nuvoco level. 1,350 crores will be used to pay the debt, and also with the strong cash flows in this fiscal and next fiscal, we are looking at a debt to EBITDA ratio of close to 1.3 to 1.35 times end of next year. That's the kind of number we are looking. and we are very comfortable with this kind of debt levels end of FY23. In terms of capacity utilization, it's a little bit kind of elaborate one. We'll have to look at the Nuvoco capacity utilization, we'll have to look at the NVL capacity utilization, we'll have to look at the North capacity utilization. Let me just take one at a time. At a consolidated company level, our capacity utilization in Q1 was 76%. That was because of the COVID lockdown and the partial lockdown, and markets are not fully opened up. But if I were to go back to Q4 of last year, we had close to about 95% capacity utilization, with all the volumes of NVCL and all the volumes of NVL were sold off in Q4 of last year. Our target in FY22 and FY23 is again going to take the capacity utilization to about 90%. End of FY23 will reach 95% levels, with the debottlenecking of clinker as well as the grinding units which are going to come in place.
The next question is from Gaurav Birmiwal from Credit Suisse. Can you quantify the potential synergy benefits from the various transactions?
Okay. We just spoke about the four main pillars of synergies which are coming out of combining of New Vista and Nuvoco. They are basically on the revenue side, on the profit side, the procurement synergy sides, and the fiscal benefit sides. Let me just take one at a time. On the revenue side, synergies are going to come from the pricing acceleration program and making the range of products in both the companies. That is the first savings we are looking at. On the cost side, the savings are going to come from fully implementing the captive power plant and waste heat recovery systems, which is close to the tune of about 50 rupees per ton. The logistics synergies of making Nuvoco products in New Vista and New Vista products in Nuvoco, which will reduce the primarily distance of the combined entity from the current 390 kilometers to 350 kilometers, will generate another 50 rupees per ton in terms of the freight cost savings between the two companies. The third major savings is routing the clinker from the Risda side to the grinding units in Panagarh, Babua and Jajpur via the Sonadi plant, which is a NVCL plant. This is slated to give close to about 1.5 crores per month saving, totaling to about 18 crores per annum. The fourth major savings which will come is the best manufacturing practices transfer between the two companies, where we are trying to change the raw mix design as well as that is slated to give about 15 crores of savings between the two companies. The last big savings which we are targeting is coming out of the exploiting the fiscal benefits which is coming out of the Babua unit in Bihar, the Panagarh unit in Bengal, and the Jojobara expansion in Jamshedpur. This is slated to give about 25 rupees incremental savings coming out of increased fiscal benefits. And lastly, with the scale benefits coming out of Nuvoco and New Vista, we are looking at a fixed cost rationalization to the tune of about 50 rupees per ton. All this totaling together, we are looking at over a period of 18 to 24 months, an incremental 250 rupees per ton coming out of synergy unlock between the two companies, out of which our target is in FY22, we are targeting 150 rupees per ton, and in FY23 and the further 100 rupees per ton, with an EBITDA of 975 rupees last year fiscal. With this synergy benefits, we are looking at a incremental 250 rupees coming out of synergy, or we call it the internal levers to increase the profitability.
Thank you. Zed, would you like to take an audio question, please?
Sure, sir. We move on to our next question, which is from the line of Satyadeep Jain from Ambit Capital. Mr. Jain, may we request you to please mute the webcast and unmute your microphone and proceed with your question?
Hi, can you hear me?
Yes, we can hear you. Please go ahead, sir.
Hi, thank you for the opportunity and for all the details. Couple of questions. One, I believe there was a favorable verdict on the Nimbahera mining lease. So after that verdict, I guess the requirement is only for you to get ECFC approval. Is that correct? And also for Nagaur mines, do you have ECFC approval now, or is it still pending?
Yeah, let me just talk about the Nimbahera mines. So obviously, these two mines came to us through the Imami acquisition. The Nagaur was auction mine. and that had a stamp duty issue which got resolved during the IPO raising time. So that's kind of cleared for us. The second one is the Nimbahada. Again, this had a little bit of an issue because of the MMDR, but we got a favorable verdict for us, though the final other steps have to be taken. So we're looking at close to about maybe 1-2 years to get all the approvals done and the land acquisition to be done. But in a space of next 2 years, we'll have both these mine available. The Nagaur mine, we have to start mining at a very, in the next 8 to 12 months, which things are underway right now. Nimbahada, it will happen post the land acquisition as well as the final approvals from the government bodies.
And Nagaur would be how much? 120 million tons or?
Nagaur deposit is close to about 150 to 170 million tons of limestone.
Okay. Thank you. Secondly, on the incremental savings you outlined, 250 rupees per ton, and including 150 rupees per ton in FY22, of which is it incremental to what you've already done in first quarter, or how much incremental savings are you looking at from what you've already outlined in first quarter? And most of the incremental savings, and that would also mean the cross sourcing and premium product sales and all. Some of it has already been realized in the first quarter, I would believe. And second part of that question would be, when you look at increasing the premium sales, is it fair to say maybe Concreto volumes would remain somewhat similar and the incremental volume expansion will come from PCC and some of the other products, or would you see expansion in Concreto also within the overall premium product mix?
Okay. In terms of the first question, as I said, the number of 250 rupees per ton is split into FY22 and FY23, which means in Q1, we already started accruing some bit of savings out of the synergies which happened. In fact, Q4 of last year, we had a very minuscule amount of saving, but in Q1, some amount of savings has already started accruing to the company. So the 150 plus 100 will include the savings that has happened in the Q1. I won't be able to give you whether exactly out of this 250, whether 25 rupees came or 30 rupees came. But suffice to say that from an actual number of 975 rupees per ton which the company clocked in fiscal 21, we are looking at an incremental 150 coming in fiscal 22, another 100 coming in fiscal 23. That's the kind of build-up and target we have set for ourselves. The second question which you asked was about the premium. Of course, I think one of the key agenda for the company is to play at the premium category. I have to go back a little bit a year ago to explain what I want to tell. Till the acquisition of Nuvista, NVCL was always short of capacity in East India, and we had to pull back Concreto from one of our key markets, Orissa, because we didn't have grinding capacity. But now with the combination of Nuvista and Nuvoco, and also with the expansion of the Jojobera facility, we now have grinding units in Bihar, Bengal, Jharkhand, Chhattisgarh as well as Orissa. Sensing this opportunity, we already relaunched Concreto in Orissa market a few months ago, and close to about 25-30,000 tons of Concreto volumes has already come back to our kitty. Last year, our average Concreto sale, not last year, the year before, last year was a truncated, or if I take the H2 of last year or fiscal FY20, the average sale of Concreto is close to about 2.5 lakh tons per month or 3 million tons per annum. Our target is to increase this number substantial level, and I will not be able to exactly tell you whether Concreto will go up by 3 million to 4 million or not. But I will tell you very clearly that our premium product portfolio for the company is close to about 35% of the trade volumes. That number we are targeting in NVCL to take to 38%, and in Nuvista that number is 25%. And our plan is to take it to 28%. Coming to your question about whether we will get premium through the composite cement or not, of course, composite cement is a new category product which is launched in the product. As you would have seen in our presentation, we have positioned Concreto as Duracard Silver, which is on the premium category with AdStar back. So, of course, we will try and get the Concreto going as part of the premium. So, to end the answer, Concreto will grow on its own with the additional grinding capacity which we have. And of course, we'll get more slag-based products or composite cement products in the premium category as well.
Okay, thank you so much.
Thank you very much. I now invite our next questioner, that's Mr. Shravan Shah from Dolat Capital, to please go ahead with his question. Mr. Shravanshah, would request you to please mute the webcast and unmute your audio connection and proceed with your query.
Can you hear me?
Yes, sir, we can. Please go ahead.
Yeah. Sir, my first question is on the RMC part. So in FY20, we had a strong RMC revenue of 1100 plus, and even now post the things are normalizing in terms of the COVID. I would not say the 100%, but still the RMC revenue even this quarter and the last quarter of the March also were much lower versus a normal run rate of 280 to 300 crore quarterly. So how do we see, as we have already given a guidance in terms of the cement volume, 20 million ton for this. So for RMC, any guidance, and also on the EBITDA margin on the RMC front, how do we see going forward?
So we are one of the strong RMC players in the country in the top three. We participate in all the four regions of North, South, East, and West, and in certain markets like South as well as East, we have very strong positions. We are in the top two positions in the regions. Before the onset of COVID, we had close to 65 plants, and that is how in FY20 we had our revenues, as you little while mentioned. But during the COVID times, one of the biggest impact happened in the metro construction, metro not as in metro rail, but construction in metro cities and towns. The construction, building vertical construction reduced, and hence the overall ready-mix consumption also reduced. And that was also the time when we also sorted out the model to get reduced credit terms, introduce cash and carry business, and also focus on value-added products, which we are very strong about, to make the business much more profitable. And in FY21, obviously, it had an impact due to COVID and reorienting the business. And also, we reduced the number of plants from 65 to 49 in places like Bangalore. We had to turn off the tap. In Chennai, we had to turn off the tap. In Mumbai, we had to turn off the tap. But however, over a period of Q3 and Q4 and Q3 and Q4 of last year and Q1 of this year, the business is quickly coming back to normalcy. But however, in Q1, a little bit of COVID impact, but I think that's kind of gone away. And Q2 of this year, the business is coming back to about 150 cubic meter per 150,000 cubic meter per month levels. It is already reached. The peak number for the business was close to about 230, 240,000 cubic meter per month. We've already reached about 150, 160,000 cubic meter per month. And in H2 of this year, our target is to get back to 175 and 200,000 cubic meter per month. And we're fairly confident that we will reach the number because the market has already picked up. But what is noteworthy is the way we are running the business. Now we have close to about 35-40% of the business which is cash and carry. The credit terms of the business is reduced from 90 days to 45 days. And we are really picking and choosing the customers who are having very good credit worthiness so that we don't have any issues going forward in terms of people defaulting on payments. And the last thrust area for the business is to increase the value-added products. We used to do about 15 to 18% 2 years ago. Right now, our portfolio has got 25 to 26% of value-added products, which give us higher contribution margin as well as higher realization. So if you really look at where are we looking at ready-mix business this year and going forward, in H2 of this year, the business will come back to a reasonable level. When I say reasonable level, it will hit 200,000 cubic meter per month kind of a number. And we are reopening new plants. We are restarting the mothball plants. We now have the Numaligarh refinery project approved. A plant has come up in Assam. We are now more or less finalized the bullet train project, and we are setting up plants in Gujarat. We are setting up a couple of new plants in Mumbai as well as Nagpur. And you will see the business growing back to about 60 odd plants by end of this year, fiscal next year. What is our medium to long term plan? We are really looking to grow this business because this is a business where we are very conscious about. It is a prestigious business for us. In the next 3 to 5 years, like we want to be an aggressive growth player in cement, we will also be an aggressive growth player in the ready-mix business. And our target is to get to about 100 plants in the next 3 to 5 years. And that automatically will give us the business revenue and growth. The last question which you asked was the EBITDA levels for the business. The EBITDA levels of business are slowly coming back to FY20 numbers. In fact, in quarter 1 of this fiscal, the business has already started becoming EBITDA positive. And going forward, our target is to make the business get back to what it was in FY20 numbers. But more important is we will still focus on the return on capital employed at a double-digit level comparable to some of the other leading players.
So, so in FY20, what was the EBITDA margin for RMC?
1 second. It was about 60 divided by. It used about 5.5 to 6%. That's the kind of EBITDA numbers which we clocked in FY20.
Okay, sir, I need couple of data points. First, on the cement volume for Q4 FY21, 1Q FY21. That is for the actual revenue what we book and not for like-to-like comparison, and for entire FY21. So for FY21, Q1 FY21 and Q4 FY21, what's the cement volume?
Since this involves too many numbers, is it possible for you to drop an email to us and we'll give an email answer to you with all details? If that works for you, I can do that.
Sorry, sir, it's a three numbers I need. Q4 FY21 cement volume, Q1 FY21, and full year of FY21. The actual volume representing the revenue.
I'll give you Q4 FY21. The cement volumes is 10.3 million tons. In 1Q FY22, the cement volume is 4.2 million tons. In 1Q FY21, the cement volume is 2.9 million tons. And overall FY21 cement volumes is 17.3 million tons.
Okay. Okay, and couple of data points for this quarter, Q1 FY22. What is the trade share? What is the lead distance? Versus, even if you can help me, what was the last year? So as you were saying that there is a synergy benefit coming. So just to wanted a trade share, lead distance for this quarter and the YOY comparison.
Yeah, the trade share for this quarter for the company is 76%. And our target is to get to 85% in the next 12 to 18 months. So, and in terms of lead distance, you wanted the lead distance. Let me just give you the lead distance. Okay, the lead distance for Q1 FY22 for the company is 336 kilometers. And Q1 FY21 was 351 kilometers.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you very much. I would now like to invite Mr. Gavin Disa to go ahead with the chat question which we have received. Over to you, Mr. Disa.
Thank you, sir. There's a question from Aditya Bansal of Nomura. He said, what would the company's priority be in the near term? Would it be further debt reduction or expansion into West and Central India? And secondly, are we looking at organic expansion or looking at further acquisitions? What is the priority?
Okay. Our stated position on this is quite clear. With the deployment of IPO proceeds as well as the strong results of the company which we are targeting in this year and next year, we are looking at a debt to EBITDA ratio of close to about 1.3, 1.35 times end of FY23. And that level we are pretty comfortable, and we would not have any plans to reduce the debt further, because the business generates sufficient amount of cash at that point of time, and our target will be we will have enough cash generation to put up a new line every 2 years. And in our business plan, we are looking at setting up of new plants 18 months after listing, so that the overall business grows to further levels going forward. With this kind of growth ambition of company for the next 3 to 4 years, plus the current debt reduction plan and the cash flows that are being generated in the company in the next 3 to 5 years, with this kind of assumptions which we have made, our company will become a debt-free company by FY26 at the current levels of debt reduction plan, expansion plans, and retiring of debts. That's the kind of numbers which we are talking about. But I want to kind of underline a point here. The company will be generating enough cash from now on to put up a new line every 2 years, which technically will be very difficult to put up a new line in 2 years. but the company will be so healthy to generate such kind of cash flows going forward. The second question which you asked was, what is the kind of organic growth plans for the company? So as we spoke a little while earlier, in the next 2 years, the focus will be to reduce debt, infuse not too much capital, but at the same time infuse about 1,000 crores of capital to debottleneck and get the capacity for the company going from the current 23.8 to excess of 25 million tons. That's the immediate target in the next 24 months. Post that, our plan is to enter Western market and Central market through a greenfield site, which currently we are targeting as Gulbarga, with a grinding unit in Maharashtra and getting into the Western Central regions. The capacity of the plant has got two models, but currently it could be even a 10,000 TPD line with a split GU or a 6,000 TPD line with a lesser capex and a phase 2 expansion. So I think that we will decide in the coming 12 to 15 months. But our plan will be first brownfield expansion, then a greenfield site. Your question was whether we would be open to M&A opportunities and further. In the last 12 years, the group has had the ability to do 6 acquisitions in various business spaces, and we are pretty active in the market, and any of the investment bankers reach out to us if there is a very good opportunity. But as we stand today, at least our view is in the next 12 to 18 months, we don't see some attractive assets coming on the block, but certainly if anything comes up, we would not kind of step back.
Thank you. We take the next question from Krutika Podar, who asks if we could please share the sales volumes excluding Emami for Q1 FY21.
FY21 excluding Emami, NVCL did 1.7 million tons and Emami did 1.1 million tons. Overall, between the two companies, we did 2.8 million tons. F1Q FY21.
Question from Urmik Chaya of Asian Market Securities. Has the order been placed for Risada bottlenecking? If yes, by how many TPD?
The Risda bottlenecking is involving two parts. One is, as we speak, the kiln has gone on a shutdown and modification work has already started. So the principal component to increase the debottlenecking of the plant is getting a different girth gear and getting the equipment ready for higher capacity. So that should happen in the next 4 to 6 weeks. Post that, not a major investment will happen. We're looking at close to about 80 odd crores to kind of refurbish the Risda kiln to getting the capacity over to 11,500 tons per day. Then the question which you asked about, I guess, is any ordering has happened is about the Nimbol kiln. There we have placed order for getting a mill to augment the raw mill grinding. That should happen in the next 9 months, and then the project is kicked off as we speak.
Could you take a question on audio then, please?
Sure, sir. Thank you. I now invite our next questioner, Pinakin from JP Morgan, to please go ahead with his question. Mr. Pinakin, I would request you to please mute the webcast and unmute your microphone and proceed with your questions. Thank you.
Sure. Am I audible?
Yes, sir, you are. Please go ahead.
Yeah. Thank you very much, sir. Sir, I have two questions. My first is from EBITDA per ton expansion from Q1, 1238 rupees a ton. You have talked about a 250 rupee per ton synergy. In terms of costs increases in the variable cost increases, how do you see the trends given what we have seen in terms of the coal costs?
Yeah, I think in terms of the numbers which you achieved in Q1, which is 1228 rupees per ton, had a cost efficiency impact as well as the pricing impact which happened in the markets which we got benefit of. But as we entered Q2, some of the pricing went away. But as we are entering September, the pricing is coming back. So one can say going forward, I think we would have a positive impact of the prices. But certainly in terms of fuel prices, whether it is pet coke or imported coal or diesel prices, there is sufficient increase, in fact, not sufficient, abnormal increase in costs of fuel. For example, the rupees per million cal, which trended in Q1 FY21 was 1.09. In Q1 FY22, it is 1.22. And I think currently pet coke are all trending at close to 1.8, 1.9 rupees per million cal. But what as a company we have been able to do is all our kilns have the capability to process multi-fuels. The northern plants were largely a pet coke driven kiln, whereas the eastern plants always had a mix of pet coke and regular coal. So just to give a number to you, in Q1 FY21, we had a pet coke as a company level I'm giving. We had a pet coke to normal coal ratio of 58% pet coke and 41% coal was used in FY21. Whereas in the corresponding Q1 FY22, this number has changed to 77% coal and only 20% pet coke. So basically pet coke price really went up. So we kind of changed the fuel mix to kind of manage the pricing. But more important thing is the thrust of using alternate fuel in the company. As we had spoken during our roadshows, 3 of our kilns already have the ability to process alternate fuel, namely the Chittor kiln, Arasmeta kiln and the Sonadi kiln. In Q1 of this year, we now started using alternate fuel in the Risda kiln and the Nimbol kiln. Some amount of capex is also going to be spent in all these kilns to process the various types of alternate fuel, namely carbon black or other kind of recycle items. So our target is to get the alternate fuel to about 6% during this fiscal year. Chittor alone, we have the ability to process about 15-16% of alternate fuel. So with this combination of using alternate fuel, flipping between coal and pet coke, and also getting the kiln efficiencies going, we will have the program to compensate for the fuel increase. But if you asked a question about what will be the variable cost increase, I think sitting here, it is going to be very difficult to predict which way the coal is going, because every week I get a chart which says how the coal prices are going internationally, how the sea freight prices are going internationally. I don't think it's going to be very easy to predict which way the coal is going to go. But certainly, at least for November, December, I think the prices are not going to be reined in. It is going to go up one way only.
Sure. This is very helpful. So my second question is basically on cement pricing. I mean, some industry checks have indicated that pricing in Eastern India did weaken in July and August. And you mentioned that there was some change in prices. How have prices behaved in Eastern India? How much did they correct by? And what is the trend right now?
So I'm talking about East. No, obviously, East, whatever prices we had in exit March or Q1 average, obviously when we came to Q2, the month of July and August, price did get correct because of the seasonality and monsoon and little bit of drop in demand. But as we enter September, there is more robustness in price. There has been a price increase which has happened in the last 4 to 5 days, and that has partly offsetted the price drop which happened in July and August. There is also price increase in the northern markets since 3-4 days. So overall, between east and north, there is price correction to the tune of close to about 2.5-3%, which has happened in the last 1 week.
So the prices have gone up by 2.5 to 3%, and how much did they correct by? So basically, trying to understand, sir, prices in September would be closer towards June or will be closer towards March. Where will prices be?
I think it will be very easy, very difficult for me to kind of sitting here say what will happen in the next 2 to 3 weeks, because the impact of all the price will happen over a period of time. The WSP has to settle in the market, get stabilized in the market. But I can give you a number. That's why I said when you ask this question, what is the correction that has happened in the last 1 week, which has impacted both the eastern market, northern market. But the very exciting thing is trade as well as non-trade prices have got corrected, which is very good for us. Because normally what happens in the industry, all of you would know, trade prices go one way and non-trade prices generally are not corrected. But I think the positive thing is at a non-trade level as well as trade level, prices have gone up at a similar level in both the categories in east as well as north. And I'm only expecting that the current price increase will get stuck to and remain in a similar way by the time we hit end of September.
Understood. Thank you very much, sir. That answers my question, sir.
Thank you very much. I now invite our next questioner, Mr. Amit Murarka from Motilal Oswal, to go ahead with his question. Mr. Murarka, I would request you to please mute the webcast and unmute your microphone and proceed with your question. Mr. Amit Murarka? As there is no response from the current questioner's line, we will move on to the chat question. Over to you, Mr. Disa.
Thank you. A question from Bhumika Nair of DAM Capital. Says, congratulations to the team. What is the reason for freight cost increase on a per ton basis in Q1 FY22 versus Q4 FY21? And please speak about the impact of diesel costs and savings in Q1 FY22 from lower lead distances or direct dispatches, if any.
Okay. I think the freight cost increase in Q1 FY22 vis-a-vis FY22 vis-a-vis Q1 FY21 is basically three reasons. One is obviously the diesel price increase happened. The second one is in the states of Orissa and West Bengal, we changed the business model from X to FOR. So there is a little bit of a notional change in freight cost because overall P&L doesn't get impacted. But I think when you move from X to FOR, then the freight cost increases. So that's what happened in Orissa market as well as parts of West Bengal. And the third one was late in March, early April, we had to increase the freight cost in the state of Chhattisgarh. So all the industry, the entire industry had to increase the freight cost because of demands from the trucking association. The overall freight cost increased by close to 9% on a year-on-year basis. However, a lot of it was moderated by the synergies between the two companies, which is how the lead distance for both companies have come down from 356 to 336 kilometers, which is a good 20-kilometer reduction in the primary freight distance. The other reason for increase of distribution cost in Q1 FY22 versus Q1 FY21 is in FY21 during the lockdown period, our Chhattisgarh plants could not restart on time and we had to use the Jamshedpur facility to service the market in Q1. And which would, whereas in this quarter, the share of Jamshedpur has increased because during lockdown we could move clinker from Chhattisgarh as well as to Jojobera. This itself has kind of increased the freight bill little bit more on a like-to-like basis from Q1 last year to Q1 this year.
The next from Harsh Mittal of the Systematics Group is, please tell us what's the current gross debt as at 1 year first quarter end, Q1 FY22.
Sorry, say it again.
The gross debt position as at the end of Q1 FY22.
Q1 FY22 vis-a-vis what?
Oh,
6,880 crores was the gross debt at the IPO time, which we have declared to the market all the times. Which would have slightly gone up in end of June. Manish, you have the number for end of June because of the working capital changes.
This is 6,885 crores is the net debt as of 30th of June.
6,886.
Next question from Girish Chaudhary of Spark Capital. Says, with competition adding large capacities in the medium term in the eastern region, what is Nuvoco's strategy to maintain market share? In terms of volume growth for Nuvoco, will you be able to grow above industry or below?
So this question has got two parts. The first part is about how other industries are increasing capacity. I will ask Madhumita to talk to you about the capacity expansion plans which other companies have announced vis-a-vis ours. And I will come back later, after Madhumita finishes, I will talk about our strategy to get share in the same market.
Right. So just initially to set a perspective on the numbers, in the eastern region, we are looking at an 85 million ton market size slated to grow at a 9 to 10% level. That means this market is adding 8 million tons of cement demand year on year. Just to go back to Q4 of FY21, there was a time when post-COVID, the industry recovered. And in the eastern part, there was a acute clinker shortage. Clinker utilization rose over and above 90%, and the industry had to get clinker. We ourselves tried to get clinker from other parts of the country, which obviously has a cost inflation pressure, and therefore prices go up in the market. Where we stand now, the top 5 players in the eastern region account for practically the whole of the clinker capacities within the eastern region. We have seen plans announced by 2 of the lead players to add 6 million tons of clinker capacity over the next 2 years. So we see about 6 million tons of clinker capacity translating to about 7.5 million tons of cement demand, just about coming in towards the end of FY23, early FY24. So there is going to be a tightness on clinker availability in the eastern region. We ourselves have our debottlenecking and capacity increase plans. We have a good head start with a 1.5 million ton capacity commission in Jojobera. And as we mentioned in a part of our strategy piece of the discussion, we are committed to retaining and growing our share in the eastern part of the country.
Just to add to what Madhumita said, in terms of our overall growth ambitions in the country, so currently we are at 23.82 million tons, and then with the debottlenecking and rest of all the brownfield expansions happening in the next 12 to 18 months, that will take the capacity of the company by end of fiscal 23 to about 25 plus million tons. That is how this company will grow in the next 18 to 24 months. The next level of capacity increase will happen with the greenfield site, which we have indicated in our plans, which will get the company to, if it is a 10,000 TPD land, will get close to 5 million tons of cement. If it is 6,000 TPD land, we'll get a 3 million tons of cement, which will reside in the next 12 months. Our stated position is our eastern region, northern region are all well set with the 11 plants, and the new facility which we are planning to have will help us enter the markets of western and central markets. So which would mean in the medium term, next 3 years, we are not looking at any capacity increase in east by way of a new line, in addition to the debottlenecking which we are doing. If the market itself were to grow at about 8-9 million tons every year from this year to next year to year next, then automatically what is going to happen is, at a medium term basis, then the Nuvoco share will always come down. But that is because we are very clear that in the medium term, we don't want to have increase our exposure in east. Instead, go into markets of west and center and be a company which is playing in east, north, west and center.
The next question from Girish Chaudhary of Spark Capital says, in terms of slag procurement, how is the supply arranged? Are the contracts long-term or on spot basis? Also, if you could give us trends on slag costs.
Okay. So overall, if you see we have a long-term tie-up with Tata Steel in the state of Jharkhand for our Jojobera plant. There we have a 20-year contract starting February 2019 all the way to 2039, 20 years in the future. And the tie-up for us with Tata Steel is to the tune of 2.1 million tons plus 0.5 million tons. The 2.1 million tons comes with the stated price, and the 0.5 million tons is reserved for us, but we have to pay at market price. So at the 2.1 million tons is starting with a number of close to 530 rupees per ton, but the formula is to kind of have an indexation formula based on a WPI going forward. So that's how we are currently standing. The other 0.5 million tons is coming out is negotiated at market rates. And in other places in Panagarh and Jajpur, we have short to medium term contracts. When I say short to medium, they're all kind of 1 year, 15 months, 3 months or spot for the plants. And there we have to buy slag at market prices. In fact, Manish during his presentation said in Q1, one of the reasons why we mentioned that slag prices has gone up, and with our internal efficiency, we are able to rein in the raw material prices. So slag prices are trending at pretty high levels in East India right now. But in our view, it is not sustainable. But we are one company which is favorably placed with the bulk of our slag requirement coming out of the contract with Tata Steel, which is for 20 years from now.
The next is from Raghav Maheshwari of AMSEC. Can you please share your fuel mix, and can you share the share of WHR in our power mix?
Okay. Fuel mix, I'll ask Manish to share. But in terms of CPP WHR, just want to say that overall captive power plants post the commissioning of Jojobera and Arasmeta plants will be 150 megawatt of CPP, and the waste heat recovery systems are all implemented in all the plants: Nimbol, Chittor, Risda, Arasmeta, and Sonadi. That is about 44.5 million tons over megawatt. Overall, we're looking at own generation of 195 megawatts, which is close to about, once implemented, which will happen in Q3 and Q4 this year, close to 70% of our power requirement will be own generation. In terms of fuel mix, I'll ask Manish to give you the numbers in terms of coal and petcoke.
Yeah, sure. So in the Q1 of this financial year, if you have to look at the fuel mix, so coal is 77% and petcoke is 20%, and the balance 3% is coming from the alternate fuel. In terms of the coal requirement also, out of this 77%, 26% is met through the linkage coal, and the balance 51% is through the non-linkage coal.
Zed, if you could take it forward with the audio questions, please.
Sure, sir. Thank you, Mr. Disa. I now invite Mr. Amit Murarka from Motilal Oswal to go ahead with his questions. Mr. Murarka, please go ahead.
I hope I'm audible this time.
Yes, you are audible now. Please go ahead.
Yeah, hi, thank you. On clinker, I just wanted to check what was the production in 1QFY22.
What is 1QFY22 production? Right now, it will be quite difficult to rattle out the clinker number. Can I send an email to you, please?
Yeah, sure. Yeah. So also related to that, I mean, generally, as you endeavor to improve the trade share and I believe improve the blending ratios. So one question that was coming to mind is that Double Bull, which is like a economy brand, as you mentioned. So when you're looking to premiumize the mix, what is the objective of launching an economy brand in a market where it doesn't exist?
So our logic is the following. I think Double Bull is a fantastic brand. I don't think anybody has established a brand of 5 million tons in a short span of less than 5 years. And it has got such a wonderful brand equity in the markets which is operating, typically the eastern market, wherever it is operating, different channel. And when we combined both the companies, we took a decision that we will not combine the channels. We will run the NVCL channel separate and the New Vista channel separate. So they are all kind of complementing channel to each other, because there is no cross linkage between Nuvoco product being sold in New Vista and New Vista product being sold in Nuvoco. To that extent, they are independent channel, separate sales team. So that's the logic which we adopted when we combined both the companies. In the northern markets, we have capacity close to the tune of 5 million tons per annum, and the Duragard as well as the Dermax brand as well as the non-trade channel, still we have not been able to fill the factories with selling all the 5 million tons. So one of the tasks which we embarked was, let us go and establish a different channel in North India independent of the NVCL channel and put the Double Bull brand in the market there. And that's what we have done in the last 6 to 8 weeks. And we would parallelly run the Double Bull channel at a different price point and the NVCL brand at a different price point in northern markets, pretty much similar to what is happening in the East market, where we have good success of maintaining both the brands simultaneously.
Sure. And what are the kind of marketing budgets for launching in North? I'm sure you would have to spend building a parallel channel and the brand.
Yeah. So I guess I won't be able to give you the exact how many crores of rupees we are putting behind the brand, but we are looking at close to about, for a company, we are looking at anywhere between 50 to 55 rupees per ton as the marketing spend in the near term. And we will spend more as and when the market expects us to spend more. At this point of time, we are looking at a good 50 to 55 rupees per ton marketing spend for the company.
And also, while you mentioned the overall trade mix, could you also split it between North and East?
Okay. Again, we have to look at three companies: the NVCL East, NVL East, and NVL North. The NVCL East has a trade to non-trade share of close to about 90 to 10%. 90% is trade and just about 10% is non-trade. The NVL East is close to 65-35%, 65% trade and 35% non-trade. Similarly, the NVCL North has a 70-30 trade to non-trade ratio. At a blended level, we are looking at currently trending at 79% trade and 21% non-trade. Our endeavor will be to take the company to close to 83 to 85% trade and close to about 15 to 17% non-trade.
Thank you. And just one last question. I think earlier you probably mentioned it, I missed it. How much of the synergy was already realized in 1Q?
That's why I said
of the 250 million of the 250 rupees per ton.
It will be very difficult to split whether we got 30 rupees or 40 rupees, but I have to say that last year we did 975 rupees full year. On that 975, our target is to get 250 rupees, 150 in this fiscal, 100 in the next fiscal. So part of it is already come in Q1. Little bit more granular details, I guess our team, our investor relations team can send across the exact number through an email to you.
Sure. Just maybe qualitatively, if you could mention, so is the logistics realignment with New Vista complete now? I mean, in terms of the rail siding integration and all that which you had planned?
What are the things which have got accomplished? I'll tell you. 100% of clinker which we used to move from Risda via the Tilda and Dagori railway siding in the erstwhile Imami days is now routed through the Sonadi railway siding to the Panagarh, Babua. Part of it from Jajpur goes by road because it doesn't make any sense to take by railway siding right now, and Jajpur also does not have railway siding. So for all the clinker which goes to Panagarh and Babua is routed through the Sonadi facility. So the targeted saving for that is close to about 1.5 crores per month, 18 crores full hand. So currently we are already trending close to about 1.2, 1.3 crores per month of clinker freight saving. That one is kind of tick in the box. The second one is the cross-sourcing of cement manufacturing. As we spoke, we now have grinding facilities in Chhattisgarh, Bihar, Jharkhand, Bengal and Orissa. What we have done since April is, we have now run an optimizer every month based on the sales plan of Nuvoco and New Vista, and cross-sourcing is implemented. Every month, like in the month of September, our target is close to 2 lakh tons of cross-sourced volume will be made in between the two companies. So at a steady state condition going forward, when we do close to about 19 million tons in East, this 2 lakhs can be as high as 3.5 lakhs.
Okay, sure. This is very helpful. Thank you very much.
Thank you very much. I now invite our next questioner, Mr. Satyadeep Jain from Ambit Capital, to please go ahead with his follow-up questions. Mr. Jain, I would request you to please go ahead now.
Thank you. Am I audible?
Yes, you are. Please go ahead.
Just a follow-up question. I think you mentioned that the greenfield at Gulbarga would only commence after the brownfield expansion. So, are we looking at any production from Gulbarga probably not before FY26? Is that fair to say?
No. In our business plan, we are looking at from now 5 years. So our target is to start construction 18 months from post listing. So immediate objective was to deleverage and also in the meanwhile to get additional capacity, brownfield expansion, high IRR return project. That's what we are doing. 18 months post listing, our plan is to start construction in Gulbarga. And there the land is available, the permits are done, boundary wall is completed, mines are opened. Railway siding design is more or less done. The actual plant design is not yet done. So that's where we are in. We will start work on that probably January onwards, and maybe Q3 next year or Q4 next year, construction will start. Our target is in FY25. The first clinker and cement should roll out of the plant, and the number which we have looked at is close to 500,000 ton coming there and 1.5 million coming in the next year. And that's the target as we speak right now.
Okay, thank you.
Thank you. Ladies and gentlemen, that was our last question. I now hand over the proceedings to the management speakers for closing remarks. Over to you.
Thank you, ladies and gentlemen, for joining this call. It's a very proud moment for us. Post-listing, we are hosting the first investors call, and I really appreciate all the questions and clarifications each one of you sought to us. And I would also encourage you to reach out to the company. Madhumita is our chief investor relations head for the company. She has enabled. So if you have any specific questions, do write to us. We'll find a way to answer all your queries as quickly as possible. And also, if there are any other clarifications from myself or from the CFO, do write to us. So again, Nuvoco is a leading building materials company. Our mission is to become a leading building materials company delivering superior performance. We are the largest in East, fifth largest in the country by capacity, fastest growing cement company with strong positions in cement, ready mix, and modern building materials. And we have an ambition, large company in the coming years. Thank you very much for attending the call, and see you sometime in the near future. Thank you very much.
Thank you very much, members of management.